The leaders of the big banks had a message for Congress earlier this week. Take a closer look at leveraged lending and student lending, which are growing rapidly. But what exactly are leveraged loans and how rapidly are they growing? It's time for Yahoo You. Our very own Brian Cheung is going to break down leveraged loans.
Hi, good morning. Well, class is in session, and the topic today is leveraged lending. We've heard the likes of Janet Yellen and a number of other regulators actually flag this as an issue. But what exactly is leveraged lending? Well, it's a source of funding for companies with a poor credit history, and by nature that means that they're going to be riskier. And if you think that these are just small startup companies, that's not always necessarily the case. There are larger companies, think iHeartMedia and AT&T, for example, which actually dipped into the leveraged loan market in the amount of $40 billion to finance its Time Warner acquisition. Basically, what happens with these leveraged loans is that they're carved up and sold to different types of investors. Sometimes they're sold directly to investors, and other times they're actually packaged into what they call collateralized loan obligations, where they're then bought by insurance companies and hedge funds and the like. Now, why is this such a hot field right now? Well, it has a little bit something to do with the Federal Reserve and its interest rates. So obviously we saw at the end of 2017 and in 2018 that the Fed actually ratcheted up interest rates. Now, with leveraged loans and for collateralized loan obligations, they're floating rate instruments, which means that when the Fed is actually increasing interest rates, it makes it more attractive to get into these types of instruments as a hedge to what could possibly be coming ahead as the yield curve flattens, for example. But why are leveraged loans then so dangerous? Well, it has to do with the structure of how highly levered these loans have gotten over the past couple years. Between 2008 and 2010 and 2018, the number of actual leveraged loans has gotten more levered. So in 2008, for example, the majority of the share of leveraged loans was actually around 4 times debt to earnings. But in 2018, that's risen to a majority of 6 times. As you can see, the red bars basically indicating more debt, which is 6 times the regulatory threshold for what they recommend. Banks actually don't even do it anymore. That has become a larger share in 2018. Now, the other issue that makes leveraged loans so dangerous is the fact that they're structured as what they call covenant light. This means that these are types of instruments that actually have looser underwriting standards, so fewer protections for the lender and also fewer restrictions for the borrower. Over time, in just the last 4 years, that actually percentage of covenant-light loans has gone up from the low 60s to actually the mid 70s. So this is all kind of within the underlooming cloud of what could be coming as we get into the longest U.S. expansion in history. And people worry about exactly what leveraged loans would do if there were to be default, a wave of default among these companies. Not only would it hurt the lenders themselves, but it could also hurt the actual employers, for example, the AT&Ts and the iHeartMedias of the country, and actually possibly put a lot of people out of jobs.
Well, we had Sheila Bair just the other day saying that's the real threat from these things, that as the companies can't pay the obligations they have, that they would start laying people off. But when you said the underwriting standards have been loosened, it sounds very much like a replay, not perhaps on the scale of what we saw going into 2008 with subprime mortgages and the bundling of those into different kind of investment vehicles.
Right. Well, the challenge is, who is actually holding these loans? And the problem is that in this case, unlike in 2008, where it was the banks themselves, we actually really don't know. Leveraged loans are being underwritten by the banks, but they're then carved up, as I mentioned, to institutional investors, and they're sold to hedge funds and insurance funds. Those are all unregulated industries that the Federal Reserve, the FDIC, the OCC can't see. So the problem with leveraged loans is that if there were to be some sort of wave of corporate defaults, the amount of parties that would be infected would be far more widespread. And people say that's maybe a good thing because you don't have all of it concentrated within the banking industry, but it could hurt a lot of individual investors.
But it also wouldn't necessarily, it wouldn't be absorbed by big banks, for example, that have a lot of capital behind them. In other words, these organizations that hold it perhaps are more vulnerable.
And that's the concern. I mean, we had these 7 CEOs on Capitol Hill the other day say that, this is something that is of concern, but not of concern to us because we don't hold these loans. But the issue— They said
it's something to watch.
It's something to watch because especially if these institutional investors find this risky and they don't want to get into this business anymore, the banks will not be able to sell these loans because the market will dry up and they'll be forced to hold them. Now, in a way, you might argue that would be a better off thing for financial stability because, again, as you mentioned, Julie, they do have capital requirements and are subject to a slew of other regulations that the shadow banking industry is not. But the question right now is that's not the case for the time being. If there were to be a contagion right now, it would hurt a lot of unregulated industries.